This video is going to describe our manual trading workspace. We're going to set this up in a fashion so that by looking at the data feeds and the indicators on them, you should be able to pull successful trades, especially when they are traded in conjunction with our Fibonacci retracement points. Our discussion for this video, however, will not go into the Fibonacci numbers. We're going to just look at the data that's on these particular charts. We have 7 charts in this workspace. Chart number 1 is the upper left. When you look at TradeStation workspaces with multiple charts, they are numbered from top to bottom, left to right. So this is number 1, and that's number 2, and this makes number 7 over here. Okay. Chart number 1 has multiple Z-score indicators on them. In order for those indicators to plot properly, you must have the Send Charts workspace open and running. Without that, the data will not be propagated. This particular chart normally would have our strategy on it. Now, if you don't have the strategy, that's fine. We're not here to talk about the strategy. Although today it just so happens that the strategy is doing very well. But that's not the purpose of our discussion here. For Z-score to show up, the send charts have to be open. Each of the other charts has market internal data that's being plotted. We use the $ ADVUS in chart 2. Chart 3 has the premium. Chart 4 the VIX. Chart 5, 6, and 7 is tick data. That's the TICK data, or the difference between the up and down of that particular data feed. Chart 5 has the tick of the NYSE. That's $ TICK. Then we have the tick of the S&P, and finally the tick of the Russell. The concept behind how to use this workspace is very simple. We want the slope of the Z-score to agree with the direction of the trade on all of our data feeds. Now there's a couple of exceptions to that. The VIX, for example, works inverse to the Spoos, so that slope is going to be just the opposite. And slope is not the only thing that we're going to look at on the premium, and we'll come to that in a minute. But conceptually, the idea is when we're close to a Fibonacci retracement point, we want to enter that trade when the slope of the Z-score on the bulk of our data feeds agrees. It's just that simple. So to illustrate, you'll notice that our trade signals are doing just that. Slope is agreeing here and here and there and so on. Slope is agreeing. Now let's talk about each of the individual data feeds themselves. Here we have the $ ADVUS. This stands for the advanced decline of the entire U.S. stock exchange. And that's why this data feed is so valuable. When it pivots, you will see almost a direct correlation between it and the movement on the Spoos. It works very, very well. We're using a brick size on the Renko of 5. You may want something a little larger, that's fine. But the brick size that I want so that I've got a little bit more sensitivity is a 5. You could go to 10 or you could go larger. I'm not going to make a judgment about that. As it is with almost all of the data that we're going to be looking at, with the exception of the VIX and the premium, there is a known range, and it's good to know what that range is. To get that range, increase the size of the Renko, go back about 15 weeks, or even a week will do, and just plot the data. And you will see that there's definitely a range to the data. For example, the upper range is shown here. The lower range is shown here. Based upon the brick size that I've elected, a 500 brick, I'm also seeing other pivot points are fairly well defined over an extended period of time. It's good to know where those ranges are. And then take that information and plot it back on the chart that you're working with. That way you'll have an idea of at least the numeric range of that data feed, and you can expect certain things are likely going to happen when you get closer to those values. Now, just looking at the data that we have on the screen at this time, you can also see that there's some other ranges that have been hit several times today. Right in around here on the upper side, there's another range right around here, right around in there, and so on down the line. Keep those ranges in mind. Big things can happen when you reach those levels. I'm going to spend a little bit extra time on this data feed, but the information that I'm going to describe is true for all of the data feeds that we look at. The ZScore, for example, I'm going to just change the size of the subgraph here. Here's the Z-score. Z-score is a function of standard deviation. So when the data, as expressed in the indicator, moves to the upper or lower range of its standard deviation, you can expect things are going to occur. And sure enough, they do. So when you're reaching a standard deviation of 1, and I've drawn a horizontal line right at about that level. Okay, there we are at 1. Or just below 1.5. That's the point of exhaustion. And the same is true on the lower side. About 1 standard deviation below to a maximum of about 1.5. That's about as far as she's going to go. So when you're looking at the data, if you're looking to short the market, you really don't want to think of taking a short unless you're at your upper range on your standard deviation and you're sloping down. You don't want to take a long trade unless you're at the lower range of your standard deviation and sloping up. Now, if you happen to get divergence, that's a wonderful thing. But don't rely upon it. So let me talk about that for a minute. Let's just look at this move here. Now, on this indicator, the ADVUS, we were at a higher high, lower high on the Z-score, and we saw a big move. All right. The Z-score showed up the divergence, because we were at a higher high on the Spoos, lower high on the of the ADV-US, and the market shorted. Of course, it also happened in conjunction with the consumer confidence report, so take that into consideration as well. But what I want to say now about the ADV-US is very important, because you may begin to watch it and you begin to formulate a concept that there is a direct relationship. It's not quite direct. For example, if the AD pivots, you should be seeing some change in direction of the S&P. Now that's true, but let's just suppose you're at a high of the ES right here. Now just imagine this for a moment. Let's just say we're at a high on the ES right here, and the AD goes even higher, and you're not at a new high on the S&P, on the Spoos. Does that mean that this is indicating that the S&P will go higher? No, it does not. Do not think that just because you went higher on the AD that you will go higher on the S&P, on the futures, on the ES. It's not directly related. You can be at a lower high. Let's look at an example of that. Hypothetically, this is a lower high compared to over here, and you could be at a higher high on the Spoos. So don't worry about that relationship. It doesn't necessarily hold true. So once again, your futures can be at a new high, but on the AD you could be at a higher high or a lower high. Doesn't make any difference. So there is no direct relationship between those numeric values. Divergence does not necessarily mean that you're going to get a change in direction. Again, let me clarify what I'm saying. Let's just say right there, all right, you're at a lower high on the AD. Maybe you're at a new high on the ES. It doesn't mean that this is a divergent situation that will result in a change in market direction of the ES. Don't think that. The only thing that you should be concerned with is the slope. Now, as far as the slope is concerned, you can anticipate a change in the slope by looking at the indicator. But the indicator should only be read in relationship to the data feed off of which it is coming. I hope I just made that clear. All right. Let's go over to the VIX. The VIX moves opposite to the Spoos. VIX is going up, Spoos are going down. So to relate that back to what we see happening on the Spoos, I've changed the color of the Renko. Normally Renko bricks are going to be red as they're going down, but in this case they're green when they're going down because the Spoos should be going up. Second point, I've wrapped a Bollinger around the VIX. Why? Well, if you're not aware of it, Mr. Bollinger, when he designed the indicator, designed it to track the options market. VIX is a function of options. Little wonder the VIX or the Bollingers work very well on the VIX. But keep in mind that the brick size I've used is a 0.01. That's as small as it goes. You can go higher, you can change your brick size, that's up to you, but I like it because it tracks really well. Now, what did we just say about Z-score? Z-score is a function of standard deviation, and friends, you got to keep in mind those standard deviations are important. When you move much more than one standard deviation away from the zero line, you can pretty well rest assured that the VIX is going to change direction. Now, it may not change direction for very long, but it's going to change direction. So when you're looking to make a trade, all right, you can expect that some movement is going to take place with the S&P when the VIX moves close to its maximum standard deviation off of the Z-score. You could expect, as it moved down here, just beyond one standard deviation below the zero line, you got a divergence in here at 937. Yeah, you're into the lower Bollingers. You've got a divergence situation here. Oh, and I haven't even mentioned the percent B over here. Let me just take a second about that. I forgot to mention it. TradeStation came out with a new indicator called Bollinger percent B. It works like a Bollinger, but the thing I like about it is that it nicely identifies high probability pivots when it exceeds zero, when it drops below zero or above 100. Oftentimes those are good points. Okay, just keep that in mind. I'm not using it in any kind of formula. I've just been tracking it just to get an idea as to how well it works. But I like it. It may be useful to you too. But let's get back to the Z-score, because that's the primary thing that we want to look at here. Here you've got what? A divergence in the Z-score. You're not quite into the zero line, or pardon me, you're not quite into one standard deviation below, but you're at a lower low. Okay, now you got a divergence. You can expect the VIX is going to start moving up. Spoos are going to start moving down. Here you got a short. Here you got a long. Okay, higher high on the VIX, lower high on the Z-score, still right into about one standard deviation from the zero line. Bollinger over here also confirms that. Long trade, 1008. Short at about 937, long at about 1008, 1009. Works out quite well. Let's go to our next data feed. The next data feed that we'll talk about is the tick, and I won't go into a lot of detail on the tick and versus the tick of the S&P versus the tick of the Russell. What we'll say about the tick is going to be true for the other three data feeds as well. So let's just expand this for a moment. Here again, it's good to get your ranges. Know what your ranges are. So go through that little exercise. Find a brick size that gives you a nice range of data. You want to go back a few days on this and just pick out where your ranges seem to be maximizing. Now, I don't use a 100 tick bar for plotting this data. I use a 50. I just put that up there for the purpose of determining my range. But in the real world, I'm going to use this. So when I plot this, what is going to be true here is again being based upon my the slope of the z-score. But bear in mind, there is a maximum range, 1 to 1.5 above or below the zero line is pretty much your maximum standard deviation before you can anticipate that the data feed is going to pivot. So if you so happen to get into an upper range, as you did right in here, you're at an upper range here as well as here. You're at your maximum standard deviation, so you could have been looking at a possible short right at around 10:55 or 11 o'clock. There was a short. You're going to use your other data feeds to confirm that, but here you've got a real good indication there's a short happening or a short about to occur. We'll confirm all of that in just a minute, but I just want you to keep that in mind. Again, do the same thing on these other data feeds. Know what your ranges are. Go through that same process. Increase the Renko size, look back at the data, set up some ranges, and then watch for your standard deviations. Same is true on the Russell. Okay, so we're using the same approach. Now, let's take a look at this. Now, just look at my global indicator here. I was at an upper range on the tick. I was not at an upper range on, for example, the tick of the Russell. I was on the tick of the S&P. All right. The AD was getting ready to slope down. You see that here as well. The VIX is moving up. So I get a short. And that short is still working. Thank you very much. Okay, see all that? Works very well. All right, now what we didn't talk about so far was the premium. Now I'm plotting the premium with a Renko. I may decide not to continue using this approach, but I wanted to see if it would give me a little bit more information than I have used in the past. And so far it's working pretty well. While the slope of the z-score is important, it is not as important as the position of the z-score relative to the zero line. So here's the rule. When you're watching the premium, which is a leading indicator, if you're going to go long, the z-score should be above the zero line, as well as sloping up. If you're going to go short, it should be below the zero line, sloping down. The z-score that I'm showing you here is based upon the bricks. The z-score that is showing up in chart number 1 is the raw data. So here again, z-score doesn't drop below the zero line until right in here and in here. Okay? The slope was dropping right in here. Another way to look at it, look at this is even more vivid. See how the premium here Z-score is just going above the zero line. It's green, in other words. We changed the color as soon as it moves above or below the zero line. And wow, nice long trade. Nice long trade. Short now. Slope on the Z-score of the premium is secondary to its relationship to the zero line. So keep that in mind. Now what we've got going here is the fact that the Z-score at because it's reflecting the brick of the Renko. I wanted to see if this would give us a little different picture, and it does. For example, right in here, it's below the zero line, and see where that's at here. Z-score of the raw data was just above the zero line. Now, without expanding this, that may not be real clear, but that's what we're seeing here. So that's why I'm still kind of toying with the plotting of the average Z-score via a Renko brick as opposed to the raw data. My mind isn't made up on that yet. So the principle, nevertheless, is the same. You want to make sure that that Z-score is below the zero line. And the slope is negative for short, positive for long. And there you have it. That's really all we're doing on this workspace. Now, yeah, is that a lot of data to look at? Yes and no. I mean, it's really not that tough, especially if all you use is chart number 1. You want to take a short trade, make sure that your slope is negative. You're best off if the Z-score is at a maximum standard deviation above the zero line. And long trades, maximum standard deviation below the zero line with an upslope. Now, when you start to add to that the position of the premium, as well as your Fibonacci numbers, which we're not talking about in this video, you got some real good opportunities to trade. So let's just pick off a few, all right? In no particular order, all right? Look at the premium here. Premium is pretty much staying below the zero line. All right, lower. Let's say this again. Lower low on the Spoos. Z-score is beginning to move more consistently above the zero line. It happened here. It's true, right? But we didn't really get a change in the slope of the Z-score on the Russell. Okay, look at the Russell here. Russell is now moving up. It's below the zero line, a little more than 1 standard deviation below. All right, now you're 1 standard deviation below on the AD. You're quite divergent on the tick here, right? Because now you're above. It didn't all agree until right in here. So here's your caveat. Are you always going to be 1 standard deviation or better at the time that the slope changes? No, that's not the case here. So keep that in mind. There was a nice long trade in here. slope didn't agree until right in here. You had everything working for you, and now you're about 2 ticks below that low that occurred here. If everything agreed, then you were 1 standard deviation or better below on all of your data feeds. But that doesn't always happen, as you can see. So just keep that in mind. You can make some exceptions. So those are some of the rules that we would recommend that you think about when you're lining things up. Don't require all of your data feeds to be 1 standard deviation above or below the 0 line when you take your trade. You want your slope to agree. The standard deviation move should be true on the bulk of your data feeds, but not necessarily all of them. And you'll wind up getting some real nice trades. And if you go with the premium will keep you out of trouble. Now here, it's a little late. On that short, okay, premium didn't drop below the 0 line till right in here. By then, you were already below the 0 line for the short trade on the bulk of your data feeds. You were up above the, you were at about a 1 standard deviation right in here, but the premium didn't yet agree. Where are we at right now? This is probably still moving down. The overall direction is still moving down, I would think. Okay. So that's what you're going to be watching, and I think you'll find a real good success as you use this in your manual trading. So that pretty much covers all of the issues that you want to be concerned with using this manual trading workspace. And then in our next video we'll talk about the use of our Fibonacci points. To keep track of the Fibonacci, you'll probably need to have that on a different workspace. But those are just numbers. You can keep those numbers in your mind. So if you have any questions, email me, let me know, but that should pretty well establish what you need to know to manually trade using this workspace, and that concludes this video.